You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplified ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today, I have the pleasure of speaking with Drew Dickson, the CIO and founder of Albert Bridge Capital. So thank you so much for being here, Drew.
Well, thank you for the invite, Sri.
Yep. So Drew, could you sort of share a bit about your background, how you got into the business, and also a little bit about what Albert Bridge Capital, focuses on, or what it does, for someone who might not be aware?
Yeah. So my background, I grew up here in the States in Indiana. I went to school at Purdue, unfortunately, very one-dimensional, always been focused on finance in one form or the other. Yep. I was a commodity trader for a few years after university, and then went back to business school. And from there, started working in asset management, but focused more on international markets. So I spent some time in Hong Kong with Fidelity Investments, and then they moved me to the London office after I finished graduate school. And that was just over 20 years ago, and was basically a stock picking analyst there. But in the interim, I had studied at the University of Chicago and started thinking a lot more deeply about these notions of behavioral finance and what is it, if there's anything out there that makes the markets inefficient, what could they be and why? And could it be that some of these biases that you and I have and human beings have are part of the reasons why we get these opportunities to potentially generate alpha, and maybe we can't. And there's an efficient market school that's, pretty deeply entrenched in this notion that prices are broadly, actually they think they don't say prices are right. They just say prices are pretty much always wrong, but we can't guess which way they're wrong. And over time, it's a futile exercise to try to do so. And then there's those of us active managers who have a different view. But ours is very much built on this notion that there are potentially some rare instances where you can do stock research. Yeah, try to see things more clearly without bias, and not just try to find the biases of others, but hopefully mitigate some of your own in this whole attempt to at least process information and be more objective and analytical about the opportunity set for the companies we're looking at. So from Fidelity, in London, I went to the Oxif. Oxif had a London office there. And from there, with some other Fidelity alumni, we managed money externally for the Man Group, which is now part of GLG. And then launched what was called Dickson Capital in 2008, which was ultimately bought by Perella Weinberg, which is a New York-based, at the time, sort of investment bank and asset management firm. And then we spun off of their platform in late 2014 and early 16. We launched Albert Bridge, running essentially the same fund we've been running at Perella. And that's been my path.
But that's really cool. And the best part was when you were at Chicago, you got to work with both FAMA, and you were also a research assistant for Richard Taylor, the legendary behavioral finance professor and writer. So could you sort of explain, number one, what it was like to work with both of them, and number two, how were you able to sort of consolidate both of their views? Fama was sort of the EMS type of guy, while Taylor was more of what Taylor sort of pointed out to biases in the market that could be taken advantage of. So what was that like?
Well, it was fascinating, and for anybody that was there at the time. And to be clear, I never worked for Gene. I was just a poor student of his. I wasn't smart enough to be a PhD, but was able to take his sort of PhD level courses and barely get by. But no, I mean, he's just an incredibly smart person, and thoughtful, and I'm not even sure he gets enough credit. He's constantly trying to tear down his own work, and he's trying to poke holes in the efficient market theory. And he and Ken French came up with a 3-factor model that basically argued that the single factor CAPM was quote unquote dead. And it was actually he who encouraged Merton Miller, who was sort of the head of the school back in the 90s. It was Fama who encouraged the whole faculty to bring Richard Thaler down from Cornell, and Dick had been this sort of leading light in this movement called behavioral finance or behavioral economics, which was trying to poke holes in the efficient market theory and utilize a lot of the psychology discovered by folks like Daniel Kahneman and Amos Tversky, but from an economics angle. And so those two were sort of, and still are, frankly, the sort of pillars of both sides of the argument about how markets work. And what I naturally was a bit more, leaning towards Thaler's view of the world back then, and I did get a chance to work with him on some projects outside of class. This is going way back before you were born, Sri. But this was during the tech bubble when things were just wild and crazy. And this is 98 and 99, so we had some fun times looking at some of the things, the reasons why perhaps the bubble was happening. But what's impressed me about both of them, and this is a rare occurrence now, and especially in this social media driven world, the two of them, despite being on opposite ends of the spectrum and disagreeing vehemently about many things, are great friends and golf buddies and tennis buddies, and enjoy each other's company. And I like that aspect of it too. It's this intellectual debate between the two of them. And the PhDs obviously got to see that every day. And I got a little glimpse into that world when I was at Chicago, and have tried to stay mildly plugged into it. And but the whole goal of that, and it will be for you as you go through your career, depending on what career you choose to take, Sri, it's always about creating the ability to continue learning long after school's over, long after you're done studying, quote unquote, whether it's your undergraduate degree or graduate degree or whatever you do. And the University of Chicago was great for that. I'm a big fan of the more theoretical approach to sort of, at least in finance, of understanding what drives things and having a foundation from which you can decide which path to take, but one that allows you to keep learning as you get older and older and older and older, as I have.
Got it. And, sort of Fama, I believe when you were speaking with Tobias Carlyle, sort of said that, Fama sort of also taught you some rigorous mathematical foundations as well. So now how have you incorporated, quantitative analysis into your process, versus qualitative, reading through annual reports and so on? What is that?
Yeah, it's a very good question. And that's evolved a bit over time. I am almost still entirely the sort of more qualitatively focused. And that's using the term based on what a quant would say qualitative is. What we might have all said 20 years ago, if you're doing deep dives and building earnings models and trying to understand what the drivers are to value, and doing a lot of financial modeling, that might have been called quantitative work 20 years ago, rather than the qualitative, hey, this is a good management, this is a good management team. But actually diving into the financial analysis of the company, the returns on invested capital, the key value drivers, and understanding what's impacting them in the dynamics between competitors in the sector. That's most of what I do. But having this Chicago training, particularly since I think the world's changed a lot over the last 20 plus years. This notion of what drives returns, this notion of what drives excess returns, it's now increasingly sort of codified into this idea, or these ideas. Fama and French started it with value and size, but these factors, this factor zoo, as John Cochran calls it. all these things that are potentially impacting returns. The market's appetite for not just market risks or for value or growth, but maybe there's an appetite for quality. Maybe there's an appetite for betting against beta. All these things that potentially are impacting returns that are not idiosyncratic. So the way these nerds talk about what could drive returns, they'll set up a regression equation, and you'll have excess returns on the left-hand side. On the right-hand side, if it's in a single factor CAPM, you'd have beta. Okay, how sensitive are you to the market? How much will your returns co-vary with the market? And that's what folks, and this is sort of Sharp-Lintner, Black, great stuff. It was groundbreaking stuff, but it sort of created this notion that it was our sensitivity to the market that drove returns. And if you did better than the market did, it must have been because you had more covariance or more risk, more sensitivity to those factors, or to that single factor. And then people did a lot of work in the 80s, not just Fum and French, a lot of folks alongside them, but they really sort of put it together, saying, hey, actually, look at this. If you bought value stocks or you bought small caps, it was the sensitivity to returns of those things that drove your returns. It wasn't even really the beta. So they did this 3-factor model. And people have been expanding upon this ever since, including Fum and French, who now include some sort of quality/profitability metrics in their 5-factor model. Yep. But at the end of all this, Sri, means that if there's all these things that we can get now in factor models from DFA, which is Gene Fama's firm, or from AQR, which is Cliff Asmus's firm, if we can buy quality as a factor risk without the idiosyncratic exposure, if we can buy value, if we want it, no one wants it now, if we can buy momentum, if we can buy these factors, then what's left in this regression equation? We've gone from a single factor to a multi-factor model now with all these different things we might have sensitivities to, and an epsilon at the end, which is random. And if there's anything left there, it's alpha that we used to sort of call alpha these things which had a lot of this stuff inside it. Well, I'm a stock picker. I like to buy good companies that are cheap and they're high quality and they're exhibiting good fundamental momentum in the business. And that's what makes a good stock. And sure, you'd buy the stock in 1994 and it would go up and you think you generated alpha. But in fact, it might have been a lot of just sensitivity to people's appetites for the exhibits of the features of the company that the company exhibited alongside 100 other companies. So what's left for the true stock picker is, I think, less than it used to be. And this remaining alpha has to be exclusive of bets on these factors, or the stock picker has to be self-aware enough to realize that their excitement, and this happens to me too, their excitement about certain ideas might not just be from the idiosyncratic risk about the company specifically, but from almost the market opportunity that it's given you because quality is so cheap or value is so cheap or whatever it is. But you have to be careful with that because timing factors is a difficult pursuit, and I'm not sure that's one that's wholly sustainable. But anyway, I try to, back to your original question, it's a long-winded answer, Sri, but I try to at least understand what factor exposures we have in the portfolio, and we will have a value tilt broadly, but not a huge one, just a little one. But we'll time vary back and forth between having a higher quality portfolio and a portfolio of less high quality. For us, we're just looking for the delta. If we can buy great companies when the market thinks they're good, that's potential alpha. If we can buy mediocre companies when the market thinks they're lousy, that's the same alpha. Robert Novi Marx, another academic, has done a lot of great work on that. The alpha you can capture is from changes in people's perceptions about the quality of the business, and we find the same thing in other factors as well. So,
right. I think sort of the key insight there was that timing factors is almost impossible. And over the last few years, you could always say value is cheap, value is cheap, value is cheap, but it's still it's still done pretty poorly. So
yeah, you can say that for like the last 7 years and be wrong every year. Totally.
Exactly. Yep. And so your fund is also focused on Europe as opposed to the US, right? So number one, why Europe versus the US, and number two, is there a difference in European factors versus US factors in the way in the way stocks behave in the US, the way stocks behave in Europe versus the US?
Yeah, great questions. Why Europe? Well, initially, when I got started in the industry, I wanted to work overseas. I wanted to sort of be exposed to international markets, thinking at the time maybe they're potentially less efficient. I think it was a naive notion at the time, but that's what really got me interested in. Spent some time out in Asia, spent obviously a lot of time in Europe. But then as my career developed in Europe, my relationships with the companies and just knowing the different businesses became a sort of real high value added thing for us. And so it's as much to do with circumstance as anything else. I wanted to be overseas. I wanted to work in international markets. I was able to really spend a lot of time in Europe, particularly. And so that's where the expertise came. Now, what drives good stock picking, I think, is similar across regions. Now, there's going to be nuance in each region, and we have our own in Europe. Mm-hmm. And there's things you learn over time about just your interaction with companies and what words mean, and if a management team says maybe in one country, it means no. If they say it in another country, it means yes. But you start to learn those things. You start to understand the harmonization of the accounting, which is broadly similar now. But there'll be some regions which are a little bit more aggressive than others. But it's, for me, what's most interesting is the very stock specific drivers to sort of become interested in the company. And to your question, are there differences between Europe and the US? I actually wrote a piece about this on our blog a few weeks ago. I think that it's actually, to me, obviously, given what I do, it's one of the most interesting questions. I propose that there are not that many differences as people would like to think. Josh Brown at Reform, Josh is great, and he disagrees with me entirely. He thinks that Europe's screwed, and he may be right. But when I look back at, if you look at these broad indices, let's say it's the S&P 500 or the MSCI Europe, or the Euro Stock 600, these sort of big, broad 500, 600 stock indices. If you start in 1970 or December 31st, 1969, and you run it all the way through, maybe it's 79, you run it all the way through the end of 2009, so 30 years, from 80 to 2010, the returns of the compound annual returns of the S&P 500 were like 11.5%, 11.51 or something. You do the same thing for the MSCI Europe, also 11.51, exactly the same returns over time. And that's just through all sorts of developments from a macroeconomic or geopolitical perspective, but the returns were the same.
Yep.
And then what's happened over the last now 11 years is it's just been all US, literally over twice. I think if Europe's generated 7.5% returns, the US is like 14.5, 15. And so I tried to study that and understand it a bit. And my point was a lot of this outperformance, in fact, a significant part of it is due to not Europe being weak or being a worse place for capital allocation, which people have argued, or being a less unified region. Again, I can poke holes in that point. I think the strength has been because of one little region there in San Francisco that houses all these massive tech companies. We've had this wonderful clustering of brains and of capital to create some of these businesses which have come to dominate the world. And that alone starts to explain a lot of the reason for the US outperformance versus Europe over this period. And then when you take a deeper dive into it, you really do see that it's actually on two ends of the extreme tree. There's, on the one end, you've got the Amazons and the Googles taking over the world. And on the other end, you have value stocks in both regions, right? And in the middle, we have a bunch of companies which are not as exposed to any of these trends. And the interesting part of it to me, people talk about how great US companies are versus Europe. It's just, Yeah, sure. In the tech space, I'll give that to you. But in the rest of the world, I mean, luxury goods, it's all in Europe. All the best luxury goods companies are in Europe. And then for all, and as you go through different sectors, there's going to be a counterpart in the US and in Europe that are broadly similar, exposed to the same consumers, even exposed to the same geographies. And I think it's a bit misleading to say that European companies are somehow worse than American ones. I think there's just as much stock picking to do in both places. But yeah, back to your earlier question, my interest is focused on developed Europe, and even within Europe, the more stock specific, potentially idiosyncratic, dynamic companies within the region.
So you tend to avoid sort of, I guess, the more frontier markets, say, a Ukraine or a Slovakia or something like that, right?
Yeah, I just don't have any expertise there, and that's I'm sure there's some stock picking to do there, and I have some friends that do that well. But to me, that's a bit more top down, and I don't.
Right. I
mean, I struggle enough trying to generate alpha just picking stocks, but trying to call markets and market direction and sort of the appetite for emerging markets and all those things it's not my wheelhouse.
Mm-hmm. Yep. And from an idea generation standpoint, how much does thinking about factors matter versus, I guess quote unquote normal reading, seeking alpha, or finding ideas in different ways. So how do you think about idea generation as part of your process?
Yeah, so I mean that's a key part of the process, and some folks that are more quantamental will indeed start with sort of, hey, let's sort of effectively build screens and look at different things that we think are interesting, whether it's value, growth, or momentum, quality, and a host of different factors. And we don't. Now, we use that at the end just to see what we're looking at, but we're broadly more, and maybe this is just how I was initially trained. At Fidelity, they basically said, okay, here's 25 companies, you're covering them, here's a credit card, go meet them and figure it out. And so that's still my approach to covering companies. It's more from a bottom up, not having a system tell you where to go look, but to start just by getting to understand the sector and the companies within it. And as you go through this process, we call our process the GAME, G-A-M-E, gather, analyze, model, evaluate. And a lot of that is, there'll be similarities to a lot of other firms that do some things at each stage similarly. Gathering information. Okay, we all gather information. We all meet with companies. We all gather data. We go to conferences. We go to trade shows. Sometimes people will pull data and try to get to information sort of quantitatively, if you like, that way, to understand what's driving consumer demand or supply or trends. But I think that's an increasingly commoditized sort of source of information. And you still have to do it. You still need to do it. But the real value added starts to come in the A stage, the analysis stage, where you look back at all that data you gathered and you say, okay, is any of it informational? How much of this is noise? And usually 85–90% of it's just noisy. And especially for companies that are story stocks or covered by folks that maybe don't have as much experience. Like even when I was younger, I'd go see a company and I'd meet the CEO, and I just talked to the CEO. He said that's that and this, and I'd write a note and I'd think to myself, I've got an edge here. I must have an edge because I've just talked to the company. There's no edge talking to the CEO. You have to do it. And over time, yes, you can see changes in body language, and maybe they're emphasizing things they didn't emphasize before. But to pretend that you're the only one doing that meeting, to pretend that there's a bunch of other buy-side analysts and a bunch of sell-side analysts that aren't doing the exact same thing is naive. Mm-hmm. And so for us in that A stage, it's just trying to figure out if we gathered any information that was novel. And usually it's the information that we didn't expect to hear. I wouldn't have expected that to happen given what happened a year ago. So that's interesting. Let's do some more work on that.
Right.
And it's those things that we find more interesting or unexpected. That's where we start to do a bit more analytical sort of work, a little less qualitative, a little more quantitative, if you will, not in the factor sense, but in the sort of empirical sense. and just build models and try to understand what the business looks like, what the P&L looks like, what the balance sheet looks like, what the cash flow statement looks like, what different valuations models will look like, depending on what we think the market will care about. And I've got a strong view about DCFs, and they are the perfect tool, but they're also easily abused. And so I would rather find better proxies for a DCF than the DCF itself, because I know that, at least in my experience, if I generally don't like a company or don't like the management team, it's very difficult for me to not let that bias into my discounted cash flow model, because you could hide your bias somewhere even without you knowing it. But if you're taking a step back and trying to find better proxies for the DCF than the DCF itself, then I think you have a better chance of being objective about it. But that's just our opinion. And so from that modeling stage, we're almost there. And those first three steps, gather, analyze, model, that's a lot of people do that. And that's, you talk to any good fundamental stock picker, that's exactly what they do. Now we might emphasize the analytical bit a bit more. We might focus on the behavioral stuff a little bit in that stage to try to make sure we're unbiased. But broadly, we all go visit companies and we all try to analyze stuff, and we all think we have the edge, and we all build models and try to understand what the business is going to look like next quarter, next year, the next 5 years. For us, the real differentiating hurdle is the E stage, the evaluation of consensus expectations. And that's where we bring in the behavioral stuff. Okay, what is it that we've just done that is why, not just, hey, look, we like this company, it's cheap, and look how inexpensive it is. We try to sort of understand the why of it. Okay, why is it that this company's trading on 12 times earnings, growing at 15% when we think it should be trading on 18? Why is it that the market is ignoring this business, which the company could monetize tomorrow if it ever just spun it out? What bias is getting in the way of people processing this information? Is it a confirmation bias because they already hated the company and they don't want to see that news? Is it an anchoring because they've been burned by the company before, which also brings in a bit of disposition bias? What is it that is preventing Mr. Market from seeing what we see? And if we can identify that, then we have a chance to not only generate alpha from seeing our fundamental modeling of the business work out, if we're accurate, but we get to see the market change its mind in that time horizon. And that's the double whammy. That's where you get the real alpha.
So what are these better proxies for DCF? So could you just sort of give us, maybe one or two examples of?
It depends on the company. It depends on what work you're doing. And Michael Mauboussin has written a great piece lately about the DCF and about how, and the McKinsey guys, the valuation book, the Bible that I still have underlined in my cabinet. There is one true value to everything. There is one fair price right now for every single security out there. We don't know what it is, but there's only one price that's right. Mm-hmm. And if there's one price that's right, then whatever metric we use to get there should yield the same number. Yep. Whether that's a DCF, an ROIC minus WACC analysis, like an economic value added analysis, some of the parts analysis, a price to earnings ratio, a PEG ratio, an EV to EBITDA, whatever metric we want to use should yield that number. So for us, we will try to use the ones that we think the market will pay most attention to. We'll try to use the ones that we think have the least bias for ourselves, and it'll be different across different sectors. If it's something that's a bit more P&L driven, let's say some of the consumer names or some of the tech names, we'll spend a lot more time in the P&L, and we'll spend a lot more time further up the P&L. We're less concerned about, particularly for newer companies or fast growing companies, less concerned about the below the line stuff and more about what's happening at the top line, the sales, and how do we break that down, and how much of that growth is driven by which sort of cohort of demand. But then you can get in some automakers, and you're spending a lot, especially when you get sort of at the bottom of the cycle, you're spending a lot more time looking at balance sheets and understanding what impacts there could be from the leverage that they have or refinancing that's coming, and just a whole host of things which would lead us to using PE ratios for one type of company or some of the parts analysis for another kind of company. It just depends on the type of business and where we are in the cycle, if you will.
Yep. So one of the questions that we got through Twitter is, what is your view on, European banks? So, European banks have, I guess, typically been, a common, I guess, value investment, but they've typically ended up being value traps. So, well, one great example is something like Deutsche Bank, which a lot of people either say, it's deep value or it's too hard to understand. So what is your view on?
Yeah. So, I mean, you could say it's not just banks that have been sort of potentially interesting value investments. It's been a lot of companies that are value-y generally, whether it's a bank or financial or not. But specifically within the banks, that falls into the group that's a little less bottom up.
Yeah.
It's a little more top down. And so we've never spent a huge amount of time in any of the financials. And I have friends who will make the argument that these things are structural shorts because the balance sheets aren't really the balance sheets and they're a complete mess. And if we really knew what was there, they're worth nothing. And then you have other friends that say, look, that's always been the case with these banks. And here we are at this point of the cycle where they're going to be spitting out this kind of cash flow. They have this kind of exposure. They've cleaned things up. And if interest rates ever were to go the other way, all of a sudden things are going to explode for them. So you can't not own them. So I don't have a huge view either way on Deutsche Bank or any of the banks, but they're interesting, but they're just a little bit too top down for, at least for my skill set.
Yep. I now wanted to get into some of Drew's views as you call your blog on your website. So number one, you say that one article that you've written is was Ben Graham a quant or something? Yeah, and you've probably pissed off like 75% of value investors just with that.
Yeah, including myself.
Yep. And so what is the purpose of security analysis or actually sitting down and doing the work when it can actually when it could potentially be summed down to just a bunch of factors?
And that's very much the question, I think, and that's the great question. That's the relative question for the market. And you can make the argument that and Mike Green makes this argument, in terms of it's all now passive flows, which are now we're not even getting correct pricing because of the flows. And I think some of his points are quite valid. I disagree with some of his points, but this notion, and I've studied it, that's what I wrote my paper on when I was in graduate school, this notion that our passive flows affecting security pricing, how many investors does it take to have price discovery? And back to the Ben Graham stuff. Now, obviously, so this was someone who was on Wall Street in the 1920s and wrote this book in 1934 that changed everybody's lives and spent 40 years espousing these tenets of security analysis. But what I think people miss is that he wrote a lot of stuff in investor intelligence, or in the Intelligent Investor, and even in security analysis, which was very, very behavioral, which was, don't fall in love with stocks. The price of a stock was the quote, the price of any share could be cheap in one range and dear in another.
Right.
And you wanted to capitalize on the uncertainty, capitalize on the market's overreactions and underreactions, which is effectively what behavioral finance is. There are two mistakes we make. We overreact to information which is vivid and recent, and we think it's more important than it is. And we underreact to information which disconfirms our previous notion. We tend to ignore stuff which makes us look stupid. And the market does too. And Graham himself, the market is a voting machine whereon countless individuals register their votes, partly the product of reason, partly of emotion.
Yep.
That's security analysis, and that's behavioral finance. That's understanding the psychology of what's driving things. And what was interesting to me is this sort of evolution of Graham. Now, he did make those comments, toward the end of his life, about sort of maybe it's smarter to just use, maybe it's just smarter to run filters and buy stocks without even doing a lot of deep dive. Just, hey, if it's below this level of price to earnings or above this level of dividend yield or whatever it is, let's put that in a model and buy 50 stocks instead of trying to kick all these tires. And there's definitely validity to that whole notion of doing so. I think where I'm landing on this is, and I think Graham did as well, is it wasn't as much about go out and buy the index as it was try to sort of, for him it was, and again, this could have been the thoughts of a man who had just been in the industry for a long time and was thinking, was there a way to do it easier, maybe at his age? But go out and buy 40 or 50 stocks that spit out through some engine. And for us, we're sort of more in the 15 to 30 stock concentration. So it's much more volatile, but very much a best ideas type of portfolio. And the proof of the pudding will be in this sort of outcome. Can you do better by buying a portfolio of 40 or 50 stocks that's generated by an engine, or better by buying a portfolio of similar amount of companies or maybe less through some process that you think is novel or a little more qualitative? And I just thought it was interesting that he would even say such a thing, that, hey, why don't we just try to make this more automated?
Yep.
Given what he had said before earlier in his career. Now, I do think, and this could be coming out soon, Jason Zweig, who's also a great student of Ben Graham's, he followed up on this whole idea, and because Graham was working on a paper that was here's how we should do it, and I think there might have been a group that implemented that work, and it didn't turn out so well. So, and maybe that's because Graham had died by then, and so that didn't that meant he wasn't involved. But these are just because we find information which presents us a concern or about what we're doing or our approach. I think that's actually positive. I think that's value added. You don't want to avoid the tough questions. You don't want to ignore information which you
don't want to be subject to confirmation bias.
Yeah, exactly. And there's the whole Upton Sinclair quote: "It's hard to convince a man of something being true when his compensation depends on not believing it." So you got to be open. Absolutely. I misquoted him there, but it was pretty close to that. And so you have to be open to all these, and then test it. Okay, would it be smarter for me to sort of have a 50 or 60 stock book that's sort of got some rules and that's driving how we get down to a number, or is there still value added to trying to be more qualitative about how you interpret the information and how you try to get rid of the noise and be a bit more selective about what stocks go in the portfolio, maybe with a slightly more concentrated best ideas approach, and you can let that number go up and down a bit. Like, is it better to have 30 stocks, better to have 20, better to have 15? Do you have the right investors to tolerate the volatility that will come as concentration increases? And all sorts of things that work into the decision about the security selection and the portfolio construction.
Right. And another one of your views that I found really interesting was something that's called the hot hand fallacy, which is that the hot hand fallacy is in itself a fallacy, which is also in itself a fallacy. So could you sort of explain how that works? And I think most people are familiar with the hot hand fallacy. Someone could be on a lucky streak of shooting hoops, and they have what is known as a hot hand, and that tends to usually be a fallacy. So could you sort of explain how that works? Yep.
I'll try to remember because it gets pretty embedded there. But I mean, back when I first heard of the hot hand fallacy, and this is back in the 90s, and this was I think it was Gilovich that did the original work, and maybe Danny Kahneman or Tversky, one of them was doing work with him, and it's broadly correct. People tend to see patterns when there are no patterns. People tend to ascribe to this sort of notion of luck, or not to luck, to sort of without understanding the randomness of chance. And so people will, think, oh, he's hot, he's or she, and they're shooting well, and really you're just seeing that because they hit 2 or 3 in a row, and hitting 2 or 3 in a row should happen if you're a 65% shooter. And so they wrote this, or Gilovich, I think it was, I could be completely wrong at this, wrote this paper, and and the behavioral finance community, behavioral economics community just really latched onto it because it was kind of what they were saying. Hey, listen, your mutual fund manager is not as hot as he thinks he is either. They're just, of course, there's going to be someone in the right tail because there has to be someone in the right tail. And it doesn't mean it's hot. That's not really necessarily skill. It could be just there's it's just random and someone has to be out there. But when it came to using basketball as a proxy for this hot hand theory, it upset a lot of purists in basketball. I was a mediocre basketball player myself in high school in Indiana. And you couldn't have told me there wasn't a hot hand because I knew when I was hot and I sure knew when I was cold, where I couldn't hit a thing. So if there's a cold hand, there has to be a hot hand. So every bit of my emotion, my background, the psychology of me couldn't process this notion that there was no hot hand. And I have discussions with Thaler about this a lot back in business school. And a lot of people did a lot of work on this, a lot of statisticians, and it turns out that there was a study that looked at the question that the potential methodology that was used effectively to determine this hot hand theory, because they would effectively start with a make. So they would look at all these different patterns and then they say, okay, someone's made a shot. What's the likelihood that he's making the next shot or she? Well, what you're doing there is you're forgetting they've already made a shot. And so you're kind of starting with already making one. And so if you started with 0 and then worked your way forward, all of a sudden it looked like that data set revealed there was a little bit of a hot hand. And then there's other things that the study would not have taken into consideration. And again, I'm going to forget some of this stuff because I haven't thought about it in a few years. But if you're a coach and someone is hot, well, you're going to double team them. And it's going to be harder to get a shot off. And when you do, you're going to have more pressure. So that in and of itself doesn't mean there's not a hot hand. It just means that there's more defense on you. If you think you're hot, you get a little, or even if you are hot, you will get a little overconfident and start taking longer shots, harder shots. That in and of itself will affect the data set. Doesn't mean you're not hot, just means you're taking worse shots because you got confident. So there's all sorts of other smaller things that also could impact the hot hand theory. But then on the fallacy, which is the next level, it turns out if you go inside that data set of what they, this whole notion of, with a 50-50 chance of making a shot or missing a shot, depending on which section of the observations you look at, when you add them all up together, it doesn't yield a whole lot of sort of persistence. It doesn't yield the hot hand that doing it the other way does. So that's the paper tries to go into that and give some of the background and what folks have written and the books that have been written about. It's a fascinating whole subject generally, and I'm not doing it justice right now, but yeah, it's the blog itself, which you're right. It's called the Hot Hand Fallacy or something. It's a nice history showing the evolution of the thought, what drove it, and the questions people are having about it as we go forward.
Right. And one last juiced views that I wanted to discuss was, so you sort of touched on it in one of your previous answers, but how much do short-term flows actually matter for share prices? And my mentor Michael Green, he's talked a lot about passive flows and how that drives markets and how that's led to the outperformance of what is really momentum and to an extent growth over value. And could you sort of just explain what your view is on how much short-term flows matter?
Yeah, well, short-term flows matter incredibly. The question becomes to me, and this is, we could spend 5 hours on this, Sri. What is it that actually something is worth? Well, something is worth what someone else will pay for. But what ultimately drives what people will pay for it is going to be the economic value, the utility you get out of the thing. And so we have this whole theory of valuation, which starts back with Merton Miller and Franco Modigliani and this sort of these principles, these propositions, this framework for for valuation and a security being worth some discount of the cash flows it generates or the dividends you receive in the future. And Graham says the same thing. But Graham also would say that in the short term, it was a voting machine. But he never actually said this. That's another interesting sort of historical anecdote. Graham never said in the long term it's a weighing machine, but Buffett insists that's kind of what he said in class. So let's just go with that. Let's say that in the short term, Ben Graham thought the market was a voting machine, in the long term a weighing machine. I believe that it is too, but I also think the difference between short and long term time varies. So in some instances, the voting machine lasts an hour. Some news, the market overreacts to it one way or the other, and then by the close of the day, it's back to kind of what it should have done. Stock should be up 2, but it's up 6. By the end of the day, it's up 2. That's a voting machine for a few hours, a weighing machine by the end of the day. But then you have some things which are voting machines for days, months, years, several years. And I think there are some cases where we see that happening now, so much so that we all have a certain, so in our careers, we have a certain window where, how long is a long time horizon? Well, how long is your career kind of thing? And it's, again, back to Maupassant, a lot of this notion of luck and skill, it's another one of those unknowable answers. There's no static answer. Is the market a voting machine for 1 year and then a weighing machine after people digest stuff, or is it continually voting? Mike will say that it's all just driven by the passive flows, and here's what's coming in, here's what's going out, and that's such an impact on prices that's all that matters, because it drives further flows, and eventually we see that this is all happening here, and this target date this, and this target date that, and the flows are happening here. And it's compelling, and there's some great points. I think that this notion that this shift to passive is driving prices is got some potential holes, because I know that even at Fidelity 30 years ago, most of the mutual funds out there are effectively passive as well. Certainly when you combine them, they are. And even at the fund level, you'll have a few big bets being made by a portfolio manager, but a lot of benchmark bets, the benchmark weights. And so, if some stock is 5% of the benchmark, and they're going to own it, they're going to own 4 or 6. They'll have a little overweight, a little underweight, but it's still 70, 80% passive already. So some big shift from mutual funds at these big institutions to passive investments at Vanguard or at those same institutions, I'm not necessarily convinced that is impacting prices. It might be impacting narrative, which then impacts prices, because people think that it should impact prices. But if the market is a weighing machine in the long term, then eventually we're going to find an equilibrium that represents the risk and reward you get from owning that stock, not some short-term sort of flow-driven supply and demand thing that's absolutely certainly affects prices. And you have to be aware of that. You have to be smart about how you engage in positions when news is happening in a certain direction and people are in a certain mood. But I think at the end of this time horizon, whether it's a year from now, 2 years from now, 5 years from now, 8 years from now, longer, there's got to be something you think this thing is worth. And then there's this sort of crazy sort of zigzag move toward that price if you're right. And you take advantage of those windows when the market overreacts to the downside. You lighten up when the market overreacts to the upside. You let the risk and reward figure in. And it has to be that the value of the thing is the value of a thing, not just driven by random flows. It's a whole Warren Buffett price and value thing. No, but again, there are smart folks out there who think Ben Hunt at Epsilon Theory thinks it's a voting machine from here to eternity. It's always voting. It doesn't matter what's happening to the fundamentals of the thing, because things will always be changing and we're always going to be voting, and we never get there. And there's some validity to it. But when I look at how I can allocate capital and what kind of cash flows are going to be generated by that thing, what kind of multiples the market will pay for that, if things are going better, if they're in a slightly better mood about the company, less biased, or vice versa, then I get a chance to generate some alpha.
Right. And to wrap up the podcast, I wanted to ask you, so very recently on Twitter, you posted a chart where you compared growth versus value, and you sort of show the chart. So you sort of compare the growth versus value from July 1998 to June 2001. So that was towards the end of the dot-com bubble versus what's going on right now. So Jan 2019 to December 2021. And of course, we aren't at December just yet, but we're almost there. So what you note is that, what started off looking like history repeating itself has gone next level. So is there actually an edge in sort of, these sort of patterns, repeating and there's a lot of people who sort of subscribe to the technical analysis school of thinking and trading. And what they do is they sort of compare price action from one period to price action from another period, and they basically implicitly make the argument that price action is fractal. So the way price moves in one instance should be the way it moves in another instance. So do you think there's actually an edge in using this sort of analysis in investing?
I have a different view than some of those that are a bit more interested in using technical analysis. It's never been a big part of my process. But what does interest me is sort of if there's anything to be learned from sort of historical analogs. And I myself, I was in college in 1987, and I was drawing charts of what was happening in 1929 and what was happening in 87. And there were so many interesting similarities. I think the market peaked in 1929 on September 3rd, and the market peaked in 1987 on like August 25th or 28th. And the sort of the moves that they had were very similar. Paul Tudor Jones, there's a
he took
documentary
advantage of that.
That always gets taken down, but he was big into this sort of concept that there was an analog between 87 and 29. And I'm not as much looking for analogs as much as just interested in sort of trying to understand what I think is potentially bubble-esque type of features of the current market in terms of the appetite for growth. You could have made an argument, and growth has been crushing value for since 2012 or whenever. You can kind of make the argument that from 12 to 17, it made sense. The fundamentals were just so much better for these growth companies. They didn't see a bunch of multiple expansion. They kind of made sense. The value companies were trashy. The growth stocks were doing even better than people expected, and they outperformed. Mm-hmm. But then over the last 3 years, things have gotten really out of whack by any measure of value or fundamentals. The appetite for growth has not been as it's not been justified by the change in fundamentals. And so, having spent so much time during the dot-com bubble, first as a student of Richard Thaler's at Chicago, and second as a tech analyst at Fidelity Investments in 1999 and 2000, I mean, that's had a strong impact on me, remembering those times and how crazy things got. And so I went back to look and say, okay, well, look how crazy things got. And some folks have pointed out, hey, there's issues with the Russell index. There's got this methodological problem. Yeah, sure it does. But whatever index you look at, if it's Russell, it's S&P, if you create your own sort of analyses, if you look at Ken French's stuff, if you look at AQR stuff and their data sets, it's all similar. There's a lot of similarities in terms of the level of froth, the level of difference in performance, in stock return, and also in the price of value, in the cost, the expensiveness of growth. A lot of similarities between now and back then. Yep. And I had started the chart you just saw. I had started doing that last year, saying, "Hey, this is eerily similar. It's interesting. Look how." And I try to find the same three. I try to be clean about it, not just picking the perfect sort of chart crime starting point to make everything look perfect. Let's find a 3-year slot, because about when the tech bubble started taking off in 98, and then let's run it out to the run up and the run back down, and let's pick when things started getting frothy here, at least in my view, and start charting it out, and it looked until I guess 6 months or so ago, it was like, oh wow, this is really similar. But the point of this, it was almost a mea culpa of some degree. It's like, hey, no, actually, no, it's not been that similar. Growth's back going crazy again, and we could discuss all day long the why of it, and there are all sorts of reasons. And back to the AQR guys, they've tried, and everyone's tried looking at, is this an interest rate thing? Is this, what is it? And all we can really conclude is that for some reason, people want to pay a lot more for things that are expensive, and are happy to do so. And, looking at the historical stuff, there's not as much sensitivity to interest rates as I would have guessed. But I still, in my heart of hearts, think that there's a little bit of that going on. This notion of interest rates being close to zero, and it kind of you at least temporarily, you throw some of that stuff out of the window in terms of what it means for risk appetite and what it means for opportunity cost and risk-free rates, and it makes things a bit wacky at this, what I think is sort of an extreme. But at the same time, things got wacky in '99 and interest rates were 5 or 6%. It didn't need low interest rates to have a bubble then. And so it could just be, this is a coincident thing, and we think there's a correlation or causation between them, but there's not. Who knows? We'll know the benefit of hindsight.
Absolutely. And Drew, thank you so much for an absolutely terrific interview. It was great having you. Before I let you go, could you sort of let our audience know where they can find you on Twitter, as well as your work on your website? Yeah. So I don't even know the website's address. It's on Twitter, it's at Albert Bridge Cap. And the website is called Drew's Views. Type it in Google, it'll pop up. I think it's albertbridgecapital.com/Drew's View. Yeah, the Drew's -views or something. But yeah, it's all there. And no, Sri, it's been great to meet you, and thanks for reaching out. Yep, thank you.